Emerging market venture capital has a scoreboard problem. Funding rounds tell us who received attention. Exits tell us who actually got paid. And South Africa just produced the number investors have spent years waiting for: cash returned. A July 2026 study examined 226 reported South African venture capital exit outcomes from 2009 through the first half of 2026. Depending on how partially disclosed transactions were treated, these exited investments generated between 2.01 and 2.45 times invested capital on a gross realized basis. That does not prove that every South African venture fund works, but it challenges one of the strongest objections to African venture capital: that startups can be created, but investors cannot get their money back. A companion study examined a selected group of 18 successful venture-backed exits across 21 investment rounds. The sample produced a 54% median gross internal rate of return, a 3.5 times median gross multiple on invested capital, and an approximately 1.6 billion rand median valuation at exit. Those are attention-grabbing numbers, but the real story is not simply that South Africa produced several successful companies. The real story is that a functioning liquidity system may be emerging around them. Emerging venture markets are usually evaluated by four visible numbers: how much funding was raised, how many unicorns were created, how many international investors entered the market, and how quickly startup formation is increasing. These measurements tell us where capital is going. They do not tell us whether capital can come back. An ecosystem becomes investable over multiple cycles only when early investors can realize returns. Founders can recycle experience and wealth, and limited partners have a reason to commit again. That is why exits matter more than headlines. They turn venture capital from a startup creation story into a repeatable capital allocation system. The research identifies four developing exit pathways: international acquisitions, domestic acquisitions, secondary transactions, and public listings. Recent transactions illustrate each part of this emerging system. Mastercard announced an agreement to acquire South African-founded stablecoin infrastructure company BVNK. Nedbank agreed to acquire payments company iKhokha. Motorola Solutions acquired RapidDeploy. Ticketmaster acquired Quicket. And Optasia completed a 23.5 billion rand listing on the Johannesburg Stock Exchange. These transactions do not prove that every startup will produce a strong return, but they demonstrate that South African technology companies now have multiple categories of potential buyers and liquidity providers. Most people will look at these results and say, South Africa venture market has matured. I think that conclusion moves too quickly and misses the more useful investment insight. In emerging markets, the buyer map may be more predictive than the funding map. The critical question is not simply, which startups are raising the largest rounds? It is, which companies are becoming strategically valuable to banks, insurers, retailers, telecom companies, global technology platforms, and growth investors? South Africa may not need Silicon Valley-sized pools of late-stage capital to produce meaningful venture outcomes. It needs companies that potential buyers cannot easily ignore. Artificial intelligence makes this buyer map even more important. AI-native startups can move faster than incumbents constrained by legacy systems, slow product development, and fragmented data. That creates a strategic choice for established companies: build internally, partner with the startup, or acquire it. My investment inference is that some of the most valuable AI-era outliers will not initially look like consumer unicorns. They may be infrastructure, payments, risk, identity, logistics, healthcare, or workflow companies that quietly become essential to a larger institution. Their strategic importance may become visible before their funding numbers do. For investors searching for these companies, four questions matter. Which industries repeatedly produce strategic buyers? Which local incumbents are becoming active acquisition channels? Can the startup become strategically necessary without requiring enormous follow-on rounds? And is there a credible path to liquidity within the expected holding period? South Africa reported median exit period is approximately 6 years, but the strongest outcomes often required longer holding periods. That timing must be part of the underwriting, not an afterthought. There are still important limitations. The reported returns are gross, not net to limited partners. Some transactions have incomplete disclosures, and the 18 exit case study sample intentionally focuses on successful outcomes. So this is a signal, not final proof. But the signal is important. South Africa should no longer be evaluated only as a startup creation market. It should be studied as an emerging liquidity system, because the next outlier may not be the company announcing the largest funding round. It may be the company quietly becoming strategically unavoidable to its future buyer.